Most people don't get excited when they hear the word taxes. For most of us, taxes are just part of life. Annoying, unavoidable, and sometimes painful. But what really makes people frustrated is hearing wealthy individuals openly admit they pay very little, or in some cases, almost nothing in taxes. It feels bizarre. You're working hard, paying everything you owe, and suddenly you hear a billionaire casually say their tax bill is tiny. It makes you wonder, how am I paying more than someone who owns a private jet? And if avoiding taxes is illegal, how are they talking about it so confidently? The real answer is that not all wealthy people are doing the same thing. Some are using completely legal strategies that the system itself encourages, while others cross into illegal territory and eventually get caught. Understanding the difference between these two behaviors, tax evasion and tax avoidance, clears up most of the confusion. One is a crime. The other is simply knowing how the rules work and using them to your benefit. Let's start with tax evasion, the illegal side. Tax evasion happens when someone deliberately lies or hides information to reduce their tax bill. One of the most common examples is underreporting income. A person might earn $100,000 but tell the government they made $50,000. They pay taxes on the smaller amount, hoping no one notices the missing half. Another example is when two people involved in a real estate deal agreed to report a lower sale price to reduce the taxes owed. They may think it's just a creative shortcut, but legally, it's fraud. Hiding money in secret accounts used to be a major tactic as well. Places like Switzerland offered strong banking secrecy, so people from higher tax countries would stash money there and pretend it didn't exist. Back then, the IRS and other tax authorities struggled to track it. But over the years, more countries have pushed for international transparency. Today, Swiss banks and many others share information, making this strategy extremely risky. Getting caught can mean massive fines and even prison time. Another illegal move is inflating or inventing business expenses. Businesses can deduct legitimate expenses to reduce their taxable income, which is completely allowed. But when someone exaggerates those costs or claims expenses they never actually paid, that becomes evasion. Maybe a shop owner spends $3,000 fixing up their store but claims $30,000. It lowers their taxes in the short run, but audits and receipts eventually expose the truth. And once they're caught, the penalties are far worse than the taxes they tried to avoid. So tax evasion is simple: lying, hiding, or faking numbers. It's illegal, and yes, people absolutely go to jail for it. On the opposite side is tax avoidance, which is legal. Tax avoidance is not about hiding anything. It's about understanding the rules better than most people and structuring your finances in a way that reduces your tax bill. Think of it like playing a game and knowing all the hidden shortcuts. One strategy large corporations use is creating companies in low-tax countries. A famous example was Apple, which set up entities in Ireland that, due to loopholes and conflicting rules between countries, weren't considered tax residents anywhere. Because those companies had no official home, they weren't taxed at all. It sounds bizarre, but it was done within the legal framework at the time. Another major strategy is transfer pricing. A company sets up a branch in a tax haven, then has its main company pay huge fees to that offshore branch for things like trademarks or patents. Those payments shift profits to the low-tax country. So instead of paying taxes on $1 million in the US, a company might only show a small fraction of that as taxable income. The rest legally sits in a zero-tax jurisdiction. The catch is that the money usually can't return to the U.S. without being taxed, so companies often wait for changes in tax laws before bringing it home.
Wealthy individuals also benefit from how different types of income are taxed. Regular salaries are taxed at higher rates, while long-term investments and dividends are taxed much lower. That's how someone like Warren Buffett can say he pays a lower tax rate than his secretary. It's not that he's hiding money, he's earning income in forms that the tax code rewards with lower rates. Wealthy people rely far more on investments than wages, so their overall tax burden ends up lower even though they earn far more. Then there's tax deferral. This isn't illegal and it's not avoidance. It's simply delaying taxes until later. Retirement accounts like 401ks, IRAs, or real estate 1031 exchanges let people postpone paying taxes so their money can grow before the government takes its cut. You still owe the taxes eventually, you're just paying them in the future. So here's the big picture. Tax evasion is illegal lying and hiding. Tax avoidance is legal strategy within the rules. Tax deferral simply delays the bill.
Wealthy people can openly talk about paying very little in taxes because they're usually using the legal methods, not the illegal ones. They're not cheating the system, they're playing it well. Taxes may never be exciting, but understanding these differences makes the whole subject a lot less confusing. Some people end up in trouble because they try to cheat, while others simply know the rules and use them as intended. And whether you're just starting out or building something bigger, knowing how this works helps you stay legal while making smarter financial decisions. Thanks for watching, and feel free to stick around for more breakdowns like this. See you in the next one.